Hey everyone, and welcome to The Explainer. Today, we're going to get into something that happens to pretty much every business. What do you do when a customer buys your product, but then just never pays? It sounds like a simple problem, right? But in business, how you record that lost money is actually a huge deal. So, let's break it all down. So, here's what we're going to cover. First, we'll look at the problem up close. Then, we'll figure out how to handle the accounting when that money is officially lost. After that, we'll talk about how smart businesses actually plan for these kinds of losses. And finally, the best part, what to do when money you thought was gone forever makes a surprise comeback. Ready? Let's dive in.
All right, Section 1. Let's start with the basic problem. Sometimes customers just don't pay. And to make this super clear, we're not going to talk about some giant faceless company. Nope. We're going to follow the story of a small business owner named Maya and a single hoodie she sold.
Let me ask you something. Have you ever lent a friend, say, $10 for lunch? You totally expect to get it back, right? But what if you don't? What if they just kind of forget about it? It's awkward, it's annoying, and hey, you're out $10. Now just imagine that happening again and again. For a business, that's a real problem. Well, that exact thing happens to businesses all the time, just on a bigger scale. So let's meet Maya. She runs this awesome online shop selling custom hoodies. Business is good, but she's about to hit this very common bump in the road.
So a customer named Leo orders a really cool hoodie. It's $70. Maya ships it out, and Leo says he'll pay soon. That's what on credit means. But then, crickets. Leo just vanishes. He's not answering her emails, his phone's disconnected, and Maya is out $70.
In the accounting world, this situation gets a special name. It's called an irrecoverable debt. It's a bit of a fancy phrase, but all it really means is it's money you're owed that you're pretty sure you're never ever going to see. People also just call it a bad debt. For Maya's business, that $70 from Leo is now officially a bad debt.
Okay, so Maya's lost the $70. She can't just pretend it didn't happen. Her books, her accounts need to show the truth. And that brings us to Section 2, writing off lost money. This is how you officially record that a debt is gone for good.
So why even bother with all this? Well, it's because of a really important rule in accounting called the prudence principle. All it really says is be realistic. Don't pretend you have money that you don't. If Maya kept that $70 in her books like it was still coming, her business would look healthier than it really is. It's kind of like keeping an IOU from your friend in your wallet and counting it as cash. The principle just means, hey, don't kid yourself.
So how does she actually do it? It's a neat little two-step trick called double entry. Think of it like a balancing scale. For step 1, on one side you go into Leo's account and you get rid of the $70 he owed. You credit his account to bring his balance down to 0. But wait, now the scale is unbalanced. So for step 2, you have to put that $70 somewhere else. You add it to a new account called Irrecoverable Debts. That's a debit. Now that lost money is officially listed as a business expense, just like rent or electricity.
And here's what that actually looks like in the books. See on the left, January 1st, sale, $70. That was the dream, right? The money Maya was expecting? Now look at the right, January 25th, irrecoverable debt, $70. That's the reality. By putting the same amount on both sides, they perfectly cancel each other out. Leo's account is back to 0, and the debt is officially and neatly written off.
All right, so writing off one debt from one customer is one thing. But Maya's a smart business owner. She knows Leo probably won't be the last person who doesn't pay. And that brings us to Section 3, expecting unpaid debts. Instead of just reacting to problems, smart businesses plan for them. This is where things get really clever. Maya knows that out of all the people she sells to, a small handful just won't pay. It's going to happen. So she decides to plan ahead. In accounting, this planning is called creating a provision. The best way to think about it is like carrying an umbrella. You don't know for a fact that it's going to rain, but it's just smart to be prepared, just in case. And of course, this plan has an official name too, a provision for doubtful debts. Now, the most important word on this slide is estimation. This isn't a fact, it's an educated guess.
Based on her experience, Maya is estimating how much money from this year's sales she thinks she might not be able to collect down the road.
So why do this? Well, there are two really good reasons. First, it's that be realistic rule again, the prudence principle. But second, there's another rule called the matching principle. Think of it this way. The sales Maya made in a year should be matched with the costs of making those sales in the same year. And that includes the potential cost of a few bad debts. You match the good, the revenue, with the potential bad, the expense. It just gives you a more honest picture of how you really did.
Let's put some real numbers to this. Imagine, by the end of the year, Maya's customers owe her a total of $10,000. From past experience, she guesses that about 5% of that might go bad. So, what's 5% of $10,000? It's $500. That $500 becomes her provision, her rainy day fund for doubtful debts.
Now, this number isn't set in stone. Every year, Maya will look at it again. If she thinks things are getting tougher and she might have more bad debts next year, she'll increase the provision. That increase is an expense. But what if business is great and her customers are paying on time? She might decide she needs less in her provision. And here's the cool part. When she reduces it, it's actually recorded as income for the business. It's like getting a little bonus.
Okay, it's time for our final section. And our story is about to take a very unexpected and happy turn. Let's talk about what happens when lost money returns. You've given up on it, and then it shows up.
You're not going to believe this. Months after Maya totally wrote off his debt, Leo comes back. He says he's really sorry, and he pays her $50 of the $70 he owed. This is amazing news for Maya, and you guessed it, it has a name in accounting, a debt recovered. But wait, this creates a little puzzle. Remember, we already cleared Leo's account. We brought it to zero. We told our books that money was gone forever. So where on earth does this surprise $50 go?
Well, the rule here is super simple, and it's great news. Any money that you recover from a bad debt is treated as income. It's basically like finding a $50 bill on the street. It goes straight onto the good side of the accounts and bumps up your profit for the year.
Now, there are a couple of ways to record this, but the simplest method, especially when the debt is from a while ago, is this. You just create a new account called Debts Recovered, and you pop the $50 right in there. Think of it as a special jar just for surprise cash. It's clean, it's easy, and it's a very, very happy entry to make in your books. So let's recap everything real quick. When a debt is gone for good, it's a business expense. Planning for future losses by creating a provision is just plain smart. And if that lost money comes back, that's a welcome surprise, and you record it as income. And through it all, the double entry system keeps everything balanced and accurate. We've spent all this time talking about the accounting for when things go wrong, but that leaves us with one last really important question. Instead of just getting good at cleaning up the mess, how could Maya try to stop customers like Leo from not paying in the first place? Maybe she could do credit checks or set a limit on how much people can buy without paying up front. That's where accounting smarts turn into real-world business strategy.